What if I told you there's this one book written, gosh, decades ago, that basically holds all the undisputed wisdom for investing? Like a book that even the absolute giants of investing call their Bible.
It sounds almost too good to be true, doesn't it?
Right. Well, today, that's exactly what we're doing a deep dive into. Benjamin Graham's The Intelligent Investor.
Ah, yes. The foundational text. And you can't talk about it without mentioning Graham himself, the father of value investing.
Exactly. And this book, it wasn't written last year or even last decade. We're talking 1949.
It's incredible, 1949. And yet, here we are all these years later, and it's still genuinely considered the investing Bible, the gold standard.
And the endorsements are just staggering. Warren Buffett, arguably the most successful investor ever, flat out says,
This is the best investment book ever written, period. When Buffett says that, you really, really need to pay attention. Its longevity is just phenomenal in a field that changes so fast.
Totally. So look, our mission today, it's pretty straightforward. We want to unpack the core ideas, the timeless principles packed into this really seminal work.
Yeah, distill that wisdom.
Exactly. Distill it so you, listening right now, can really grasp what it means to be an intelligent investor, according to Graham. And more importantly, how you can maybe apply some of these insights to your own finances.
It's about cutting through all the noise, isn't it? The hype, the fear.
Right. Moving beyond that daily chatter and focusing on what actually matters for building wealth over the long run, it's a perspective shift, really.
A fundamental one.
Okay, so let's unpack that, this transformative mindset. Before we even get into the nitty-gritty, the strategies, the specifics, what's the first big fundamental shift in thinking Graham wants us to make? Right from page one, essentially.
Well, what's so striking is how he immediately reframes the whole act of investing. He hits you right away with this. Investing is not gambling. It's not playing the lottery.
Okay, that seems obvious, but why is that distinction so crucial for him?
Because it combats this incredibly common misconception people have. So many approach the stock market like it's a casino in Vegas, hoping for that one lucky spin.
Throwing money at a hot stock tip.
Exactly. Or just think it's all random chance. Graham says, no, that's gambling. Gambling relies on luck, maybe some probability, but the odds are often against you. True investing, he argues, is completely different.
How so?
It's about analysis. It's about understanding. It's about treating it like a serious business endeavor, not a game of chance. This distinction sets the entire stage for a disciplined, rational approach. If you walk in thinking it's a lottery, you're already lost.
So it's about shifting from a passive hope for luck to an active, reasoned approach.
Precisely. It demands diligence, not just hope. It immediately injects seriousness and intellectual effort into the process. You're not just betting. You're making calculated decisions based on facts and analysis.
Which sounds profoundly different from chasing those quick wins or reacting to every market wiggle.
Absolutely.
Yeah.
And that leads right into his positive definition. If investing isn't gambling, then what is it? For Graham, true investing boils down to understanding a business deeply.
Not just the stock ticker, but the actual company behind it.
Exactly. The goal isn't just to guess where the price is going next week. The goal is to buy a piece of a business at a price less than what it's actually worth, its intrinsic value.
Intrinsic value. Okay, that sounds key. So what does understanding a business really involve from Graham's perspective? It can't just be liking their products.
Oh, definitely not. It's much deeper. It means rolling up your sleeves and digging into the financials, the balance sheet. What does it own? What does it owe? The income statement. Is it actually profitable consistently?
Cash flow, too, presumably. Is the cash coming in?
Critically important. And then you look beyond the pure numbers. What's its competitive position? Does it have rivals? Does it have some kind of advantage, a moat, maybe?
Like a strong brand or unique technology?
Right. And you look at the management. Are they competent? Do they have a good track record? Are their interests aligned with shareholders? Is the product or service likely to be around in 10, 20 years? It's like being an investigative journalist for that specific company.
Wow, okay. So it's serious homework, not just reacting to headlines or what's trending on social media.
Not at all. It's fundamental analysis. Rooting your decisions in the economic reality of the business, its assets, its earnings power, not just market sentiment or popularity. It's like buying a house. You get an inspection, you check the foundations. You don't just buy it because someone said it looked nice.
And if you're doing that level of analysis, it naturally connects to the third pillar he emphasizes right at the start, which, let's be honest, is probably the hardest part for most people. Emotional mastery.
Definitely the hardest.
He says it's not just about being smart with numbers. It's about temperament, patience, discipline. Why are our own emotions often our worst enemy in investing?
Because, as Graham points out, the two most powerful emotions driving market behavior are fear and greed. And these primal forces, they almost compel us to make irrational decisions, often directly against our own best interests.
How does greed trip us up?
Well, think about a booming market. Everything's going up, maybe it's a tech bubble or some new hot sector. Your neighbor's bragging about their profits. That fear of missing out FOMO kicks in hard.
Right. You feel like you're being left behind.
Exactly. So, driven by greed, by the desire for those quick, easy riches, people pile in. They buy stocks when prices are already sky high, often without really understanding the underlying business or its true value. They're chasing past performance, hoping the trend continues forever. That's buying at the top.
And fear. That's the flip side, I assume, during a crash.
Precisely. Market plunges. Headlines scream crisis. Everyone's panicking. The fear of losing even more money becomes overwhelming. So what do people do?
They sell, often near the bottom.
They sell. They liquidate perfectly good assets at bargain prices, locking in their losses, precisely when logic and Graham's principles would suggest it might be a time to buy. Selling low out of fear is just as destructive as buying high out of greed.
So it's this emotional roller coaster that really kills returns.
It absolutely devastates long-term results. Graham was adamant. Controlling these impulses, maintaining emotional discipline, is often more critical than sheer intellectual horsepower. It's about letting your rational analysis guide you, not your gut reactions or the crowd's mood swings.
So summing up that foundation, it's not gambling, it's business analysis. It's about deep understanding, finding intrinsic value, and crucially mastering your own fear and greed. That's a powerful starting point.
A very powerful and, frankly, quite different way of thinking than most people bring to the market. It requires self-awareness.
Okay, so the book introduces some really potent concepts, ideas that have shaped investing for decades. Let's dig into those cornerstones now, starting with how Graham defines who we should aim to be in the market. He draws a really clear line, doesn't he?
He does, a very stark line. It connects directly back to that initial investing versus gambling idea. He essentially says there are two ways to participate. You can be an investor or you can be a speculator.
Right. And what defines the investor in Graham's eyes?
The investor is characterized by that long-term perspective we talked about. They focus on the fundamental strength, the underlying value of the business. They genuinely see themselves as a part owner.
Like buying a slice of a real company.
Exactly. Their decisions come from deep analysis, balance sheets, earnings, management, competitive position. They are patient, they're disciplined, short-term market noise. They mostly ignore it, or even see dips as potential opportunities if the value proposition holds.
Okay, so that's the ideal. What about the other side? The speculator, the one Graham warns us about.
The speculator is basically driven by trying to predict short-term price movements. Their focus isn't on the business's value, but on guessing where the stock price might go tomorrow or next week.
Trying to time the market, essentially.
Precisely. They buy based on tips, momentum, charts, market sentiment, anything but a rigorous assessment of intrinsic value. They're betting on price changes, not investing in business substance. Graham viewed this as a loser's game over the long run.
And his advice is unequivocally.
Be the intelligent investor, not the speculator.
Hmm.
Which, of course, raises the big question, how do you actually do that consistently? Especially when speculation seems rampant sometimes and you see people making quick paper profits.
It takes real conviction to stick to the investor path, I imagine.
It absolutely does. It requires a deliberate commitment to your principles, especially when the crowd is doing something else entirely.
Okay, this leads perfectly into probably Graham's most famous, most influential concept, the margin of safety. You hear this phrase everywhere in value investing circles. What exactly is it, and why is it so foundational, it sounds like? Insurance.
That's a great way to put it. It is a form of insurance for your investments. A margin of safety is Graham's absolute cornerstone principle. The idea itself is actually pretty straightforward, though applying it takes work.
Okay, break it down.
It means always aim to buy a stock for significantly less than its calculated intrinsic value. You do your homework, you figure out what you think the business is truly worth based on its fundamentals. That's the intrinsic value.
Right, the $100 per share example we touched on earlier.
Exactly. Let's say your analysis tells you this company is fairly valued at $100 per share. The margin of safety principle says you don't buy it at $95 or even $90. You wait until it's maybe $60 or $70. That gap, that discount between the price you pay and the value you estimate that, is your margin of safety.
So you're deliberately building in a cushion, room for error.
Precisely. You're acknowledging that the future is uncertain. Your analysis, however thorough, might be slightly off. The
Yeah.
company might hit unexpected headwinds. The market might go through a rough patch.
Things happen.
Things happen. The margin of safety is there to protect you when they do. If the stock price falls after you buy, but you bought it at a 40% discount to its value, it might fall 20%, and you're still not necessarily losing money relative to its true worth. It limits your potential loss dramatically.
It protects your capital, reduces the risk.
Fundamentally, it's about ensuring that even if things don't pan out perfectly, you haven't overpaid and your downside is limited. It allows you to invest with more confidence, knowing you have that buffer. It's probably the single most critical concept for preserving capital, which Graham saw as rule number 1, don't lose money.
Rule number 1, don't lose money. Rule number 2, don't forget rule number 1.
That's the essence of it, yeah. The margin of safety helps you follow rule number 1.
Okay, and then there's the unforgettable allegory the character Graham creates, Mr. Market. This is such a brilliant way to think about market volatility. Who is this guy, and how are we supposed to interact with him?
Mr. Market is pure genius. Graham personifies the entire stock market as this business partner you have. Let's call him Mr. Market. And every single day, he shows up at your door,
Ready to do business.
ready to do business. He offers to either buy your share of the business or sell you his share. The catch is his prices are all over the place because he's, well, manic depressive, extremely moody. Some days, he's euphoric, incredibly optimistic. The future's amazing. Everything's going to the moon. On those days, he'll offer you ridiculously high prices for your shares or demand a fortune for his.
Okay, so when he's happy, his prices are probably too high.
Often, yes, from a rational value perspective. Then, other days, he's utterly despondent. The world is ending. Sell everything. He's panicked, fearful, pessimistic. On those days, he might offer to sell you his shares for pennies on the dollar or offer you next to nothing for yours.
So his prices reflect his mood, not the underlying reality of the business.
Exactly. His quotes are driven by emotion, wild optimism, or deep despair, not by rational calculation of the business's long-term value.
So how does the intelligent investor deal with this erratic partner? You can't just follow his lead.
Absolutely not. That's the crucial point. The intelligent investor uses their own judgment, based on their own analysis of the business's intrinsic value and their required margin of safety. Mr. Market's daily quotes are just offers. You are completely free to ignore him.
You don't have to trade with him just because he showed up.
Not at all. In fact, you should only engage with him when his mood serves your purpose. If Mr. Market is ecstatic and offering a silly high price for your shares, maybe that's a good time to sell if the price far exceeds your estimate of value.
Capitalize on his optimism.
Right. And conversely, if he's deeply depressed and offering quality businesses at fire sale prices, far below your calculated intrinsic value.
That's your buying opportunity. Use his pessimism to your advantage.
Precisely. You exploit his irrationality. This mental model is incredibly empowering because it helps you detach emotionally from the market's day-to-day swings. It turns volatility from something scary into a potential source of opportunity.
It frames the market as something you can use rather than something that controls you.
That's the core lesson. The market is your servant, not your master. Use its moods, don't be swept away by them. This requires that emotional discipline we keep coming back to, allowing you to be rational when Mr. Market, and often the crowd following him, is being emotional.
That's a fantastic mental tool. Okay, so Graham gives us these powerful concepts, investor versus speculator, margin of safety, Mr. Market. But it also sounds like he recognizes that not everyone approaches investing the same way. He doesn't seem to push a single rigid strategy. He identifies different types of investors, right?
He absolutely does, which is really practical. He understands people have different circumstances, different amounts of time they can or want to commit, different temperaments. So he outlines 2 main archetypes, and it really prompts the question for you, the listener. Which one sounds more like you?
Okay, what's the first type?
The first is the defensive investor. Think of this as the low-maintenance, safety-first approach.
Okay, what are their key characteristics? What do they prioritize?
The defensive investor generally prefers less research. They're not looking to spend hours digging through financial reports or trying to find hidden gems. Their primary goal, above all else, is capital preservation. They want to safeguard their principal, avoid big losses, and earn a reasonable, satisfactory return without taking on excessive risk or effort.
So less focus on maximizing returns, more on minimizing mistakes.
Exactly. Safety and simplicity are key. So their strategies tend to involve investing in large, well-established, financially sound companies. Think blue-chip stocks with long histories of profitability and maybe dividends.
Stable businesses.
Very stable. And importantly, especially relevant today, Graham suggested they could achieve their goals through diversification, perhaps using something like broad market index funds or balanced funds, combined with high-quality bonds.
So a strategy that doesn't require constant monitoring or deep individual stock analysis?
Right. The goal is a steady, secure portfolio that provides peace of mind and reasonable growth over the long term, minimizing the chance of major errors.
Okay, that sounds like a sensible path for many people. What's the alternative approach Graham outlines?
The alternative is the enterprising investor. This is the more active, more involved approach.
Enterprising. Sounds like they're willing to put in more work.
Definitely. The enterprising investor is characterized by their willingness and, importantly, their ability to dedicate significant time and effort to research. They actively seek out specific investment opportunities that the defensive investor would likely miss or wouldn't even look for.
So what's their goal? Just higher returns.
Their goal is explicitly stated as aiming for higher returns with safety, and that with safety part is crucial. Graham is not endorsing reckless speculation or chasing high-risk ventures here.
Still grounded in safety principles, even while seeking better results.
Absolutely. The enterprising investor achieves potentially higher returns by diligently hunting for bargain issues, stocks that are significantly undervalued by the market relative to their intrinsic worth. This requires rigorous analysis, digging deep into financials, understanding complex situations, maybe looking at smaller companies or special situations the market overlooks.
So they're applying the margin of safety principle, but perhaps looking for even deeper discounts or less obvious opportunities.
Exactly. They're doing the hard analytical work to justify taking positions that might look unconventional or require more conviction. They are active portfolio managers, making specific choices based on their detailed research, aiming to beat the average market return through skill and effort, while always keeping that safety net of valuation underneath them.
So we have the simpler, safety-focused defensive path and the more involved, potentially higher return enterprising path, but both still emphasize safety. How does understanding these help someone figure out their own approach? It seems like it boils down to honest self-assessment.
That's precisely it. It forces you to be realistic about yourself. How much time do you really have to dedicate to investment research each week? How skilled are you actually at financial analysis? Do you genuinely enjoy digging into company reports, or does it feel like a chore?
Be honest with yourself.
Absolutely. If you have limited time, limited interest, or perhaps recognize that detailed analysis isn't your forte, the defensive approach is perfectly sound, often very effective, think index funds, and much more likely to be sustainable for you. You won't burn out trying to do something you're not suited for.
And if you do have the time, skill, and crucially the temperament for deep dives,
Then the enterprising path might be suitable, but it requires consistent effort and discipline. Understanding these types helps you align your investment strategy with your personal reality, your resources, your skills, your personality. Choosing the right path for you is more important than thinking one path is inherently superior to the other. It's about finding the approach you can stick with intelligently for the long haul.
That makes a lot of sense. Okay, we've touched on this multiple times because it's so central to Graham's philosophy, but let's focus squarely on the human element again, mastering emotional control. Graham dedicates so much attention to psychology. Why is managing our own emotions maybe the single biggest factor, the true enemy within, when it comes to investing successfully?
It's arguably the linchpin of the entire philosophy. Graham saw that even the most brilliant analytical mind could be completely undone by poor emotional control. He states pretty clearly that the investor's chief problem and even worst enemy is likely to be himself.
Wow. Ourselves. Not the market, not bad luck, but our own reactions.
Exactly. And again, it comes down to those two primal forces, greed and fear. These emotions are hardwired into us, but in the context of investing, they lead directly to irrational, often catastrophic decisions.
Can we revisit how they play out, maybe with some examples people might recognize today?
Sure. Think about periods of intense market euphoria. Maybe a particular technology seems revolutionary, or crypto is soaring, or meme stocks are going wild. Greed takes over. People see others making seemingly easy money, that FOMO kicks in again.
And they jump in without thinking.
They jump in, often at inflated prices, abandoning any sense of analysis or valuation, purely driven by the desire not to miss out on perceived riches.
Yeah.
They chase the hype, That's greed distorting judgment, leading to buying high. Then, inevitably, the market turns. A correction happens or a crash. Headlines turn negative. Suddenly, overwhelming fear replaces greed. The primary instinct becomes, get out now before I lose everything.
Panic selling.
Panic selling. People dump their holdings, often sound long-term investments, at deeply depressed prices, cementing their losses. That's fear driving decisions, leading to selling low. Buying high due to greed, selling low due to fear. It's the exact opposite of the rational approach needed for success.
So the intelligent investor has to somehow stand apart from this emotional tide, doing the opposite of what feels natural in those moments. What does it actually take to achieve that level of detachment, especially when everything around you, news, social media, seems designed to amplify those very emotions?
It takes conscious, deliberate effort and the right mental framework. Graham believed the intelligent investor is defined not by IQ, but by temperament. It requires 1. A solid foundation of analysis. If you truly understand the value of what you own, you're less likely to be shaken by price fluctuations. You trust your analysis, not Mr. Market's mood.
Having conviction in your homework.
Exactly. 2. Establishing clear investment rules and processes before emotional situations arise. Decide your criteria for buying and selling based on value, not on market noise, and stick to it. Have a plan.
Removes the need for impulsive decisions in the heat of the moment.
Precisely. 3. Limiting exposure to market noise. Constantly checking stock prices or consuming sensational financial news just fuels emotional reactions. Step back. Focus on the long term. And 4. Self-awareness. Recognizing your own emotional triggers and psychological biases. Are you prone to overconfidence? Herd behavior. Actively counteracting them.
It's almost like training yourself to be objective.
It is. It's about cultivating discipline, patience, and that crucial emotional detachment. It's about ensuring your rational brain is firmly in control of your investment decisions, not your fearful or greedy impulses. That, Graham argued, is the true key that separates the successful long-term investor from the rest.
Okay, the book itself is quite substantial, as we've said. A true Bible. While we can't cover every single detail, Graham structures his arguments very carefully, chapter by chapter. Let's maybe walk through the essence of a few key chapters or sections, hitting the highlights that really encapsulate his core teachings. Give people a bit of a roadmap.
Good idea. It helps see how the pieces fit together. Let's start right at the beginning again.
Investor versus speculator. We've covered this, but it's worth reiterating how foundational it is. He frames the investor as an owner, thinking like a business person, and the speculator as a gambler, betting on prices. This mindset shift is everything. It dictates how you filter information, what you focus on, and ultimately your actions.
Sets the entire philosophy from the outset. What's another critical early piece?
Chapter 2. Inflation and the investor. This is crucial, maybe even more so today. Graham warns that simply holding cash is a losing game over the long term because inflation eats away at its purchasing power. Your money becomes worth less and less.
The silent thief.
Exactly. So he stresses the need for a portfolio that includes assets likely to outpace inflation, primarily stocks, representing ownership in productive businesses balanced with the stability of bonds. It's about preserving and growing real wealth, not just nominal dollars. A lesson many forget when they focus only on avoiding market declines.
Right. Playing defense against inflation is just as important. What about dealing with market history?
Chapters 3 to 5 look at the history of the stock market. The key takeaway here is that market cycles, booms and busts, panic and boom, as he might say, are normal. They have always happened, and they will continue to happen.
They're inevitable.
They're inevitable. The intelligent investor understands this history and doesn't get surprised or panicked by downturns. Their job is to remain calm through these cycles, remembering that volatility often creates opportunity for those focused on long-term value. Think of weathering the crash of '87, the dot-com bust. 2008 investors who stayed calm and rational often came out ahead.
Perspective is key.
Yeah.
Then he gets into the specifics for the different investor types.
Yes. Chapters 6 to 7 focus on the defensive investor. Here, Graham provides practical guidance for building that safe portfolio. He discusses asset allocation, emphasizing diversification, and suggests strategies like using index funds plus high-quality bonds. It's a blueprint for a low-effort, safety-oriented approach that still aims for reasonable returns. Very actionable advice.
And then the star chapter.
Chapter 8. Mr. Market. We've discussed this fellow extensively. This chapter drives home the allegory and the core lesson. Treat the market as your servant, not your master. Mastering this mental model is paramount for achieving the emotional discipline needed to buy low and sell high, or at least avoid buying high and selling low. It's about using market fluctuations, not being used by them.
Such a powerful concept. What about relying on others for advice?
Ah, yes. Chapter 9, Investor and Advisor. This is a crucial warning. Graham cautions investors not to blindly trust advisors or brokers. While good advice can be helpful, ultimately your own understanding and judgment are paramount.
Don't outsource your thinking entirely.
Exactly. Relying solely on others without doing your own due diligence can lead you astray. Self-reliance and analysis, at least to understand the basics and question advice, is incredibly important. You need to own your decisions.
Okay, and for those who want to be more active?
Chapters 10-11 cover the enterprising investor, and chapters 12 to 15 delve into financial analysis. These sections get into the weeds of how to research and select individual stocks. They focus on identifying those bargain issues or undervalued stocks. Graham outlines the practical steps: scrutinizing the balance sheet, analyzing profit trends, assessing debt levels, evaluating dividends. He strongly warns against investing based just on popularity or narrative. It's about hard numbers and business fundamentals.
The real analytical work. He also warns against complexity, doesn't he?
He does. Chapter 16 advises caution regarding complex financial products like convertible issues or warrants, which were perhaps more common then, but the principle holds. He generally favored simplicity. The intelligent investor doesn't need exotic instruments to succeed. Often they just add risk and opacity. Stick to what you understand.
Sound advice. And he uses examples.
Yes. Chapters 17-18 provide case studies. He analyzes real-world companies, from his time, of course, to illustrate how to apply his principles, identifying sound investments versus potential traps or speculative situations. This helps bridge the gap between theory and practical application.
And finally, how does he wrap it all up?
Chapters 19 to 20 serve as the conclusion. Here, Graham powerfully reaffirms the ultimate importance of the margin of safety as the central concept of investment. He reiterates that long-term success comes not from brilliance or timing, but from discipline, patience, and consistently applying these sound principles. It's a final call for rationality and emotional control.
That provides a great overview of the book's structure and key themes. So bringing it all together, what does this mean for us today? After really digging into this nearly 75-year-old book, what are the truly actionable, enduring lessons the intelligent investor offers us right now in our current market? What are the core takeaways?
Despite its age, the core lessons are remarkably timeless and, I'd argue, more relevant than ever in today's often frantic market environment. Let's boil them down. First, investing. Business ownership. Hammer this into your thinking. You're not buying a lottery ticket, you're buying a piece of a real business. This changes everything: how you research, how you react to prices, your time horizon. Think like an owner.
Focus on the underlying business, not the stock ticker's dance.
Precisely. Second, safety first. Always prioritize protecting your capital before reaching for high returns. Apply the margin of safety. Don't lose money unnecessarily. If you protect your principal, compounding can work its magic over the long term.
Preservation before appreciation.
Got it. Third, diversification. Don't put all your financial eggs in one basket. Spread your investments across different companies, industries, maybe even asset classes. It's fundamental risk management. Why is it so critical? Because the future is unknowable, and even great companies can stumble. Diversification cushions the blow.
Reduces the impact of any single mistake.
Exactly. Fourth, embrace the long-term approach. Forget get-rich-quick schemes. Investing is a marathon. Cultivate patience. Let your investments compound over years, even decades. Ride out the market cycles. Your patience is a huge advantage.
Time is your friend if you let it be.
Absolutely. And fifth, tying back to our moody friend, ignore market moods. Trust your own analysis, your own calculation of value, your own margin of safety. Don't get swept up in Mr. Market's euphoria or despair. Use as a rationality. Don't become a victim of it.
Be the rational player in an often emotional game.
That's the essence of it. These 5 principles: ownership mentality, safety first, diversification, long-term focus, and emotional control, are the bedrock of intelligent investing, as true today as they were in 1949.
It really sounds like these core ideas are timeless, even if, as you mentioned, some specific company examples or maybe some of the financial jargon feel a bit dated. So what's your final verdict? For someone listening today, maybe new to investing or just looking to improve, is this book still essential reading? Or is it more of a historical curiosity?
That's the key question, isn't it? Is it still relevant? And my answer is an emphatic yes. Well, look, it can be a challenging read, especially for absolute beginners. There's definitely financial jargon. And yes, the old company examples require a bit of historical context. The principles are absolutely timeless,
The core message transcends the specific examples.
completely. The margin of safety, controlling your emotions, thinking long term, the investor versus speculator mindset, how to deal with Mr. Market. These concepts are 100% applicable today, maybe even more so, given the speed and noise of modern markets. I wouldn't even just call it an investment book. It's really, as you suggested earlier, a financial thinking guide. It teaches you a way to approach financial decisions with rationality, discipline, patience, and a focus on value.
A framework for thinking, not just a list of rules.
Exactly. So, is it necessary reading? If you're serious about understanding the stock market, about building real sustainable wealth over time, and about making financial decisions wisely, then yes, I believe it's necessary. It lays the intellectual and emotional foundation for everything that follows. It genuinely changes how you view investing and your money.
Wow. Powerful stuff. So we've taken a real deep dive today into The Intelligent Investor, a book that clearly does more than just talk about stocks. It transforms how you think about creating and protecting wealth.
Hmm?
It seems the path to success isn't about complexity or secret formulas,
No, not at all.
but about simple, powerful principles applied with consistency.
And Graham's final word on it is really quite profound. He essentially promises that if you apply these principles diligently with patience and discipline, your success in the long term is practically assured. It's not about luck, it's about process.
A reassuring thought based on logic, not hope. So here's a final thought for you, our listener, to maybe mull over. How might truly internalizing Graham's principles, that patience, that discipline, that business owner mindset, change how you approach other parts of your financial life beyond just stocks?
Yeah, it's interesting. Applying it more broadly.
Yeah. Could you find bargain issues, maybe not in the market, but in your own spending or your saving habits? What if you applied a margin of safety to your budget, creating a buffer for unexpected expenses? How could that rational, long-term, value-oriented thinking transform your entire relationship with money? Something to think about.